So after having understood so many sheets, the final one which we come is what is the valuation of your company? Because this is the one more question which investor is going to ask: at what valuation are you trying to raise funds? Now, how do we arrive at valuation? For an idea valuation, the valuation will be different. For a startup, it will be different. For an existing company, it will be different. So there are various methods of valuations. You have a simple method which is being done by discounted cash flow method. Then next you have real asset method, and nowadays you have a lot of other things which come into existence, like your HR valuation, the tangible assets, the intangible assets that your company has, your IP and all those things. But let us make it in a much more simpler way. For example, if you are done in your business plan for your startup, you will realize that for arriving at valuation, you will have to go back to the cash flow sheet. What happens there is you will have to add up all the cash flow positive sheets. That is, for the 36 months, let us say 18 months had been into cash flow negative and 18 months has been into cash flow positive. And let us say the cash flow positive is around 2 million. So for 2 million is where you do discounted cash flow. What happens in discounted cash flow? It is basically you're discounting the cash flow on a lesser year-on-year basis, keeping in mind that if the company goes forward again, so much of revenues can be lost. That is to arrive at worst come case scenario. Let us say that first 36 months your cash flow has been positive for 20 months. So for 20 months the amount that has come in total is $2 million. So when you write a DCF method, you will again deduct that 2 million by 20%. So 2 million of 20% being 40, you are going to reduce 40,000 from 2 million, and that is how you are going to be reducing for another 2 more years. So that is basically you are considering 60 months. Now whatever the residue that is added on after reducing the DCF is what you call it as valuation. It is also called as pre-money valuation, and dividing that number by the amount you are planning to raise will give you what is the equity that you are trying to sell for this particular round. Let us say your valuation is 10 million and you are planning to raise 3 million. So the equity will be 30%. How do you arrive it? It's basically divide 10 million by 3 million, which will give you 30%. So that is what the equity that you are planning to raise for the monies that you are planned in. So you'll need to dilute 30% to raise in that 3 million with a 10 million valuation. Now let us understand how it is indirectly connected. Now the moment you keep on increasing your cash flows, if you increase your sales forecast, automatically your turnover increases and automatically your cash flow increase. That will lead you to have much more amount of cash flow positives. So automatically your valuation keeps on increasing. Now the amount required will still remain the same. So that will bring down the equity. So it is like if you are having for a 10 million valuation, if you are asking in only for 1 million, your equity will be just 10%. Why did this amount get reduced? Because you have increased your revenues. That will bring down the amount required because they are becoming cash flow positive much faster and you are reaching certain milestones. So what happens is the more the valuation, lesser will be the equity that is to be diluted. But also remember, the moment you start increasing your valuations, just because it's an Excel and it's going to give you numbers, it will automatically leave into investors. You have not even started on day one. How is this kind of evaluation? You will have to justify that. So it is always better in the first round, specifically if you are into an idea validation or raising funds for idea, you will have to dilute a lot more. But whereas when it comes to a company or a startup which has got some traction, generated, been there, done there, that way you will have a lesser amount of equity being diluted because your valuations are going to speak in terms of the actual growth that has been brought in. So usually for a startup, it is always done on discounted cash flow method or a DCF method. I mean, if you still find it that I'm unable to connect in a layman terms, I mean, just Googling it, like saying discounted cash flow will give you again the formulas, which may still lead you to confusion. So all you need to understand here is basically discounted cash flow is a method to arrive at valuation if you do not have any real assets nor real revenues of your existence. So that is where you have seen that many companies, when they go to series A, B and C, the valuations keep increasing, the amount being diluted keeps decreasing. So first go, you will have to give a good amount of chunk. That is where a lot of entrepreneurs do a mistake. Why should I do? Why should I give so much? My idea is worth more. Remember, all you're talking is all in your Excel sheet, and why would an investor pump in monies on your Excel sheet? So you have to be realistic when you are arriving at valuation. Just because it is being done on discounted cash flow, which is connected to the sales. Now you might also argue saying, when my total addressable market is 100 million, 10 million will be my sales. That is, I have just covered only 10%. That will automatically drive your valuations higher, no doubt about it. But is this a realistic approach that you can reach out? That is how you try to substantiate yourself. If an investor can buy that point, your deal is done. So that is how DCF method comes into existence. Hope it's clear. Thank you.